Welcome to my channel. What I do in my videos is I run my personalized Excel discounted cash flow model to figure out the value of a company's stock. I also look at the financial ratios of the company and compare them with its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. The company I'm going to look at is Omnicom Group. This is a marketing and PR firm located in New York City. Let's get started with the model. This company has a market cap of $11.5 billion. And let's see what they're trading at. They're trading at $53.73, so that's one share of stock. And the way you value a company is you estimate the future free cash flows and then discount that number back to today's value, which is what I'm doing in this video. And the best way to estimate the cash flows is to get their actual cash flows. And that's what I'm doing right now. I'm pulling their free cash flows for the past 4 years. And next I'm going to pull the net income, which is the profit and loss, and that's on the income statement. Now I'm going to pull the revenue, which are the sales for each year. That's also on the income statement. You want to take a look at the numbers to make sure they look okay. Revenue has been pretty steady. It's been declining a little bit each year. Although the revenue has been declining a little, their margins are improving. You can see their revenue is lower in 2019 versus 2016, but their net income is higher because they're doing a better job converting revenue to profit. They have higher margins. You can see they have a 9% margin compared to 7%. I also like to make sure the free cash flow is greater than a net income each year, which it is. Let's look at a capital structure of the company so we can figure out the discount rate to apply to the future cash flows. They pay $248 million of interest on their debt. Let's see how much debt they have. We'll go to the balance sheet. Current debt is $612 million. That's debt due within 12 months. Long-term debt of $4.5 billion, that's debt due after 12 months. They pay 4.8% interest on their debt. Interest is tax deductible, so let's get their effective tax rate. We'll go back to the income statement. Income before tax of $1.9 billion. Income tax of $504 million. So their effective tax rate is 26%, which means the cost of debt is 3.57%. Now to get the cost of equity, we need the beta. That's how volatile the stock is. They have a beta of 0.74, so the stock moves less than the market. The market as a whole has a beta of 1. Next we need the current assets. We have to calculate the current ratio later, and current assets are mainly cash, accounts receivables, and inventory. That's $14.5 billion. And we also need the current liabilities, which are the debts and payables due within 12 months. That's $15.9 billion. And the equity, that's assets minus liabilities, and that's $2.9 billion. And their earnings before interest and taxes, that's on the income statement, that's $2.1 billion. Let's look at the capital structure. The cost of debt is 3.6%, and they have 64% debt. The cost of equity is 8% and they have 36% equity. The WACC is 5.15%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. That's right up here in blue. We also estimated a terminal value, which is all cash flows past year 4. That's $22.8 billion. We discounted those numbers back to today using the weighted average cost of capital, which is here in green. And we get a value for the entire company of $25 billion. We divide that by 214 million shares. And we get an intrinsic stock price of $115. It's trading at 54, so it's trading at a 53% discount. So it's definitely a buy according to the model. Simply Wall Street's at 110, so they're also saying the stock is a buy. Let's look at the historical stock price, and it looks like it was trading closer to $90 a few years ago, but it's dropped when coronavirus hit, and it hasn't come up much since. It looks like the stock is undervalued, but I think companies like this may struggle a lot during coronavirus. Let's look at the financial ratios. They have a really good PE, a good price to sales, and an okay price to book. PE is stock price over earnings per share. And to calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 8.6. They're providing good value here. Price of sales is stock price over sales per share. To get sales per share, it's revenue over shares outstanding. And price of sales below 1 is considered great value. The stock price has come down so much that it is below 1 now. The price to book is stock price over book value per share. To get book value, it's equity over shares outstanding. So I like to see below 3.5. They're at 4.0, which isn't too terrible. They have a weak current ratio and really good ROE. Current ratio is current assets over current liabilities, and that means they cannot cover their current liabilities. So they either have to take on more debt or this could be a timing issue. ROE is net income over equity, so they provide their equity holders a great return, almost 50%. Interest coverage ratio of 8.5, so that's a good sign. There's not much risk of them going to default anytime soon. They can cover their interest payments more than 8 times. And a good way to look at ratios is to compare them to similar companies. I've done videos on WIMI, and this is Omnicom. And if the number's in orange, that means they're winning in that category. So WIMI has a better price to earnings, price to sales, price to book, and current ratio. Although Omnicom is much better in ROE, WIMI is lower in debt, and Omnicom is much bigger of a company than WIMI. I actually did a video on WIMI a couple months ago, and I predicted their stock price was about $12 when it was trading at $4. And the stock hit about $30 a couple weeks back. It's come down. I think it's around $7 now. But let me know what you think of the video. Thanks for watching.